Just like doctors check BP, sugar, and cholesterol, financial advisors check money ratios. These ratios give a snapshot of your financial health and tell you what needs to be fixed. So let's start with the first ratio, that is savings ratio. What is savings ratio? Savings ratio tell us out of every 100 you earn, how much do you actually save? Saving ratio is calculated by dividing your annual savings by annual income. So let us take an example to understand how it is being calculated. Suppose your annual income is rupees 6 lakh and you save 60,000 in an year. Your savings ratio comes out to be 60,000 divided by 6 lakh is equal to 10%. That means you are spending 90% of your income. So let us understand what counts as saving. Saving does not mean only your bank balance, but the money put into your mutual funds, fixed deposit, PPF account, shares, golds, provident fund, or even land, real estate. All counts your saving. Even employer's PF contribution in your money is also counted as your savings, though you don't see it today. Let's take a realistic example to understand the same. Suppose your gross salary is rupees 10,000. You take home 9,000. 500 goes to your PF and employer adds 500. You earn 200 as an interest for your investment. Your expenses are rupees 7,000. So your savings are actually 3,200, not zero. Savings ratio comes out to be 31%. That's excellent. What is the savings to income ratio? Savings to income ratio check how much wealth have you already built up compared to your capital. The formula for the same is total savings upon annual income. Suppose your annual income is rupees 12 lakhs and total investments till date you have created about 15 lakhs. So your savings to income ratio is 1.25, that is 15 lakhs divided by 12 lakhs. This ratio tells how prepared you are for the long term goals like retirement. Also, age also plays a very important role because at the young age, our expenses are very high and we can't save much, which is very normal. But at our early 40s, a healthy target is savings should be three times of our annual income. To reach that, savings must be increased as income increases. Now, let us understand about the expense ratio. What is expense ratio? Expense ratio is how much of your income is being spent regularly. To calculate it, the formula is annual expenses being divided by annual income. For an above example only, if you have earned 6 lakh rupees and spent 5 lakh 40,000, your expense ratio is 90%. High expense ratio leads to lower financial safety. Now let us understand what are the expenses being calculated under the head expenses. Only regular expenses are included. Any one-time expense is not being included under the expenses. Suppose you have a one-time hospital bill or you went for a holiday once in 4 5 years, that would not be included, but a regular expense that's occurring every year would be included. Also, there are discretionary expenses like luxury shopping, expensive vacations that are also having a leak in your savings. You are unable to save much because of these leaks happening. The ideal situation, how to be an ideally financially stable. A low expense ratio and a high savings ratio will provide you financial security, peace of mind, and a strong future. So, you don't need to be rich To be a financially strong, you need awareness, discipline, and the right ratios. Start tracking your income, expenses, and savings today. Your future self will thank you. In this video help you, like it, share it with your family, and subscribe to Goyal Wealth Insights for simple money education. In next video we will understand about more ratios.